Hello, this is Mark from tradinginformed.com and welcome to this video on how to trade the S&P 500 using VIX Volatility. And before I start this video, please remember that you can check out the links below. You can also like, comment and subscribe. And if you are interested in using the backtesting methods that I describe in this video, there is a link shown on the screen now that you can click at any time to have a look at the Trade Informed shop. So the inspiration for this particular video comes from an email that I received recently from Dr. Alexander Elder. Now, Dr. Elder is one of my trading heroes. I have spoken and written before about Dr. Elder's books and trading systems, and one thing stood out in this email and I thought I have just got to test this. And what he said in the email was that when the VIX index is above its upper Bollinger Band, it is a good time to buy the S&P 500. Now, what I liked particularly about this statement is it is testable. So many things that we can see and read in the papers, on Bloomberg and all the other financial news channels are simply not testable. They're just people's opinions. What I liked about this is that we can go back through the historical records and find out if indeed over the past period of time it is a good idea to buy when the S&P is above its Bollinger Band. As much as I like Dr. Elder, I don't think I should be trading this based on just his word, and I certainly I wouldn't recommend that anybody else does. So I decided to have a look and investigate the truth of this statement. So of course we all know what the VIX index is. It's a measure of the expected 30-day volatility. And of course we've all heard it being called the fear index. So when the VIX is above its upper Bollinger Band, we can say that traders are expecting volatility in the market. It maybe seems a bit counterintuitive to be buying at this moment, but if we follow the maxim mentioned in Dr. Elder's email, we should be buying when the VIX is high, and when the VIX is low, we should be going slow. So the way I'm going to test it, I've got on the screen at the moment the S&P 500 with a Bollinger Band on that. But the way I'm going to test it is in this spreadsheet, which is a Trade Informed backtest method. And as I mentioned at the start of this email, these spreadsheets are available in the Trade Informed shop. So click on the link if you want to see some more about this. Okay, so in this particular spreadsheet, I've got in yellow the S&P 500, and in this light blue, I have the VIX index. And the good thing about both of these is that they go back quite a long time. So I've got approximately 20 years worth of data for both of these. And I've done a few calculations. I've got here a Bollinger Band of the VIX. And over here, I've actually got a Bollinger Band of the S&P 500. I've got the average true range, and I've got a couple of other ideas for filters that I will show later in the video. So the first thing that I want to know is it remotely sensible to be buying when the VIX is above its upper Bollinger Band? So I've done a quick test, and there are two ways I could think of testing this. The firstly is to buy when the VIX first breaks above its upper Bollinger Band, and secondly when the VIX comes back within the Bollinger Band after being above it. So I thought I'd test both of these, and we can click on the results tab to see what I got. So just looking here at the entry criteria, what I'm showing here is the entry when the VIX breaks above the Bollinger Band. And I can click this and we can have a look. Showing true here for enter when the VIX breaks below the Bollinger Band. Okay, so we can see they're both showing, I'll click back to the original, they're both showing fairly similar results. I should mention as well that I do have an exit criteria. We need to have something. I haven't used at this moment any profit targets or stop losses. So what I have done is I have used the S&P 500 Bollinger Band as a exit. That's why I've got it shown on here. So we would have at an approximate an entry about here, and we will be looking to hold a nice positive trade until we've exited above the Bollinger Band here. Okay, the results, just looking at the capital graph, are pretty decent. We can see we've got some drawdown here. We've got reasonably similar largest winning and largest losing trade. And in fact, a similar proportion for the average. Quite like the fact we have a 70% win percentage, which suggests to me there may be something in Dr. Elder's method. Now, a couple of things I can see on the chart here. We have a few fairly steep dips in equity, and we can see, fairly unsurprisingly, these correspond to, first of all, the dot-com crash, 2000, 2001, and the more recent financial crisis crash, 2008-9. The rest of the time, we've been reasonably positive. We've got the Great Moderation here, the recovery in the Great Moderation, and the recovery from the financial crisis. Just looking at this shows to me that it is probably worth investigating a bit further. And what I've done, this is not intended to be a full trading strategy, but what I have done is have a look at how we could potentially filter this strategy to make it a little bit more reassuring. The big danger that I can see, and if I click here onto the trade analysis sheet, the big danger that I can see is we have got a handful of pretty large losing trades. We have one here in September 2008 where we've lost just over 25% of the capital, and that was followed up in early 2009 where we lose another 20%. Going back to the results here, we can see that at the time that would have been quite a large loss, and we would not be particularly keen on, we may not be particularly keen on following this strategy through the great recovery years subsequently. So what I've done is have a look at a couple of filters, and there's some of my favorites. First one of these is the slope of the linear regression, and I can show you how we could do that here. I'm just going to add another criterion into my Excel formula, and I'm going to say that whenever the linear regression slope, this is a 200 period linear regression slope, is greater than 0, we can enter long. And when it's lower than 0, we won't do anything. I double click there, copy the new criteria down. We can click back here and have a look at the new capital graph. We see this, instead of the long slide downwards, we have some flat periods. This is shown here as well, that we've got a lower maximum drawdown. And we could try it for both break above and break below. Okay, so I'm going to show you one more filter, and then we can have a little bit of a closer look at the results. Another one that I wanted to do is I want to buy. Obviously I want to buy when the long-term trade is up. This is what the linear regression slope is giving me. But maybe also I want to buy when we're having a bit of a dip. So the way I thought we can try and do that is look at the slope of a shorter term EMA. So I'm going to do that here. So I'm going to do it when a shorter term EMA is pointing, the slope is pointing downwards. Double click that to copy it down. And we see we've got, again, a slightly different capital graph. We can have a look at it on both versions of the strategy. And the interesting thing, certainly from my point of view, I always like to focus on the maximum drawdown, because drawdown more than anything is going to determine whether or not you follow through a strategy over the long term or you give up on it. Anything with a 30, 40, 50% drawdown potential is very difficult to trade over the long term, because it's very difficult to see your trading account decrease by that amount. So there are plenty of other options that I've programmed in and we can potentially try for this strategy. So one of these is, as I said, our main exit criteria here is Bollinger Band. Well, we could try a stop loss, or we could try a profit target to begin with. There we can see it makes a bit of a difference. We might well like to have a stop loss. You see again what we've got here. The effect is particularly of reducing our largest losing trade at the expense of losing some of our net profit. We could do a few other things here. We can close on consecutive up days, so I can change that to 3. So now the strategy will close. Let's lengthen that a bit. Now the strategy will close after 3 positive days. I can try 4, put it to 2, and we can see we get different results. Another thing I like that works particularly well for certain types of strategy is using a time close. Don't, generally speaking, want to have long positions in the market unless they're doing well and we're making a good profit out of them. So a time close might well be a good idea. I've got here set for 35 days. Now this is a reasonably long-term strategy, so setting it to a short amount is not going to probably have a very positive effect on it. But on the other hand, we don't really want our positions to be open for 6 months and have a large drawdown during that time period. So we can make all these changes. We can see how it affects our drawdown here. We can see how it affects our capital graph. Okay, so I hope you found this interesting. I think we've shown that there is some merit in Dr. Elder's method, Dr. Elder's suggestion to buy when the VIX is high and go slow when the VIX is low. And we've shown as well that some filters might be a good idea for this strategy. There have been plenty of times when we can buy when the VIX is above its upper Bollinger Band and the market has subsequently fallen another 20 or 30%. So I hope you like this video. Please remember to hit the subscribe button if you want to see more videos like this. And for more information about trading the financial markets and about backtesting in general, please go to www.tradeinformed.com.